Hey guys, this is another episode of Podcast with Elena, and today we're going to be talking about investing in wraps for owner occupied homes. Wraps is a pretty obscure subject with a lot of so called experts about it on the internet, but most of the time they don't show you how it actually works and the financials behind it. They just kind of pitch you the idea and leave you with it. So today I wanted to bring somebody who can show you a little bit more of the details behind the scenes, and why you should consider investing in wraps for owner-occupied homes if you want passive income. So today with me is Sam Akisami, and he is going to tell us a little bit about the subject. Can you tell us a little bit more about yourself, Sam?
I'm actually pretty. I just started raps last year, and it was just, to me, it just seemed like with the way things were going, that's going to be the new big thing. Me and my partner Ryan, we've been trying to learn a lot about raps. We did one late last year, and now we're trying to move that service on to other investors and show them that, look, this is a really great way to make money.
So you're an actual investor who has worked with wraps.
Yes.
Perfect. So before we go to, oops, sorry, my controls. Before we go too far, just two words about me. If it is the first time you're on my channel, my name is Elena Garrett, and I'm a realtor in Dallas Fort Worth area of Texas. And we are in Dallas, Texas right now. So just FYI, even though the information we're going to present is pretty generic, some of the information may be specific to the Texas market only. I have a couple of Facebook groups. Feel free to check them out. Especially important for you guys would be the Facebook group called Seller Finance DFW. I also have a Facebook group called Motivated Sellers, which could be an interest of you for those of you who are looking for properties with motivated sellers. Without further ado, let's jump into our topic, passive income through wraps. So go ahead, Sam.
When a lot of people hear about raps, they think it's something that's really confusing, and they really don't bother pursuing it because it seems really complicated. It's really not that complicated. It's just basic. It's really thinking outside the box of attaining passive income. And so here we made a comparison between the wraps and rentals, and why I personally like we're doing wraps far more than I like doing rentals. As you know, once you buy rental, that cash flow is very uncertain. There could be God knows, the landlords out there, the number of repairs that come up. The AC could go out, right? They could call you in the middle of the night to come fix something. That cash flow that you're receiving from the rent minus what you're paying on that house is not always certain. But with wraps, it is. With wraps, you get that certain amount of cash every month for as long as the loan is. So that's just one right there. You get that security that is not certain with rentals. Another thing is, like I just said, with rentals, you have to deal with repairs. With wraps, you're not dealing with that because you're basically the bank in the situation. And repairs can easily just destroy years of passive income through wraps. And a lot of people, what tends to happen a lot of times with rentals is that people just get into it and they don't realize, like, oh no, this property is actually not cash flowing. Once I've actually started accounting for all the repairs that I'm doing, this property is not cash flowing. And that's where a lot of people get into trouble. You don't get into that trouble with wraps. And of course, there's the property management. Just the ease of headache compared to having wraps is night and day. It's literally not your problem if anything breaks. Um, the last thing with rentals, harder to scale. Now, this can be there's certain ways to scale rentals, but in my opinion, I would say wraps are much more easier to scale, at least with our method, because we do wraps even a special way compared to other people. But with our method, it's much more easier to scale than what you do with rentals, because with rentals, if you're smart, the way you want to buy the rentals is that you want to buy them in a wedge. You want to buy them below market value. Now, the question is, how do you do that, right? And it's not as easy as it looks. Most of the time, you're going to be competing with other investors. You could be buying these at foreclosures.
Especially right now, I can tell you
Yeah,
right now, we had investment property in Plano, 17 offers without pictures, sight unseen, unable to visit until the offer is until the offer is accepted. 17 offers, right? I bet you they
yeah,
went over the asking price. I just bet you.
yeah. So even now, it's very difficult. And then, that's one way. And then another way is by talking to wholesalers. But the wholesalers, they probably shot that property to 100 other people, right? You don't really have that problem with wraps. With wraps, it's just whatever the client wants and whatever looks good to you and you personally wouldn't mind owning. It's that easy, and then you just buy the property at their asking price.
Actually, I'll ask you a question. So when a lot of people give talks about wraps, but what they're talking about is getting a property facing foreclosure,
Yeah.
taking it off the owner's hands, and then starting to pay is that the kind of wrap that you're talking about, or are you talking about a different wrap?
So I'm talking, we do raps pretty uniquely. That kind of rap where you're taking the lien and paying it on their behalf. Um, I know what that is. Foreclosure. Could you do that at foreclosure? I
Yes,
don't think so
pre-foreclosure.
because
You can do that pre-foreclosure. So a lot
pre-foreclosure,
of
yes,
videos online.
pre-foreclosure, absolutely.
A lot of
But then
videos online.
again,
Mhm.
right? It's about finding that
Yeah,
pre-foreclosure.
try finding that, and then
Yeah,
try talking the bank into doing it, and then try
exactly.
explaining it to the seller, and then try to explaining to the title company that the seller actually understood the
Exactly.
terms.
So there's a lot of layers in that, and I'm not saying that it's impossible to do. Some people are actually quite, I know a couple people who just do foreclosures and they do amazing at it. But it's its own ball game, just foreclosures by itself. But the way that we've done it, it's much easier to scale at a much less risk. Now, moving on to our actual next slide. Uh, oh. So moving on, I guess we go to the oh, I think you muted yourself, Elena.
Do you want me to stop sharing?
Yeah, I wanted to move on to the spreadsheet. Okay.
Now you should be able to share. Now, while you're sharing, can you explain how your model is different? So I bet you if you watch
Okay.
100 different videos on wraps
Yeah.
on YouTube, they're all going to be talking about pretty much one model. You go a distressed seller, you present him with an option of him somehow liking the idea of you taking his title and not giving him any money. And then you're supposedly promising that you're going to pay his loan for him, and he actually believes you, right? So there's a couple of questionable turns of events that have to happen in order for their system to work. Now I know it works, I've seen it working, but the
Mhm.
chances of you talking an individual Joe Blow into taking over his property and giving you the key without actually showing that you bought the property with him getting something out of it, it's
Mm.
hard. It's just hard. So
Yes.
how is your model different? What makes it different?
So with that model, you're basically doing what we're doing in the opposite sense. You're finding a homeowner who is willing to seller finance you their home, and you basically you buy it, right, which is even rare in of itself because you want that payment as low as possible, and then you're going to find someone else to then you owner finance it to them, and there you have a wrap with and in that whole process, you're going to have to do a lot more marketing because even finding that kind of homeowner is rare. And I mean, good luck trying to look for an agent or a wholesaler who's offering that, because if they find that themselves, they're probably going to keep it. I don't see why anyone in their right mind would give that away, because that is really a gold mine right there. And I've actually
Only if that wholesaler have a whole bunch of other things cooking at that moment.
like, yeah, it's just not
Dude,
um
your model gets around all because every time somebody
yeah.
told me that they're looking for wraps, and I'm like, well, I know what you're looking for. I wish you best of luck, right?
Yeah,
Your model gets around those all of those obstacles.
yeah.
How?
So thinking of the wrap, right? You want to think about who's really the end goal here. It's finding the client. It's finding the person who's gonna actually owner finance it from you. And so that's where we really start up. We have our excellent agent here, Elena, who works with us, and she's really great at finding these people who can't go through normal banks or, can't get commercial loans. And but they do have fantastic jobs and they are gaining money. And so she markets to them and they come to her because they're looking to own a piece of property, right? They're looking to stop renting, they're looking to actually start owning, and they come to her with these big down payments and she says, all right, look, I have these guys, they're going to come look at your qualify you like a bank, pre-qualify you, and we can get you inside of a home. And so that's where we really start off. And so we find these people, we then pre-qualify them, and then we start letting them shop for homes on MLS. So we skip the whole, we don't need to go look at because at the end of the day, depending on, it really just depends on what the client is willing to pay, right? If the client really wants the house and they're willing to overpay everyone else, then really the wholesaler's price, you don't need a wholesaler's property, you don't need a foreclosure, you can just do it on MLS. Now this will inflate the prices, but this is not a short-term play, and I want to make that very clear, right? In my opinion, doing wraps as a short-term play is unethical. These people are looking to own these properties long term. This is a long term play, and you want to deal with people who are serious with the long term. And as you'll soon see with the numbers that I'm about to show you, the longer the term, the more cash flow you as the investor will actually make from these deals. So as I was saying, these are long-term plays. So we pre-qualify them, get them shopping on the open market, so they'll actually get to choose what home they want to buy. And we give them the list of the numbers that I'm showing you. We'll give them what things are going to cost. Um, oh, I'm sorry, I have a little heartburn. We'll give them the cost of the property. So going in right here, right? So this MLS property is, so let's say we're looking at a $150,000 property on MLS. Our service charge would be 10%. So that'd make the client's purchase price 165. So they're not buying it at 150, they're buying it at 165. They're putting 15% down, which is 24,750. So the loan will be 140. The interest rate is 9.5, which a lot of people tend to think is really high, but is actually really normal when it comes to owner finance. You want it above 8% at least. Um, the loan term 30 years, and um, the minimum monthly payment would be this. And so this actually, funnily enough, matches some clients' current rent. Like Elena, I know you've talked to clients, and their rent is actually sometimes even, if not higher than that. So, this is the number that a lot of these clients focus on, is the minimum monthly. And if they can, if they make times through this, then we're doing fantastic. And so this with this calculator that we built, it has the automatic, it automatically puts in the earnest and option. These are all the closing fees that we got from HUD, from the deals that we've done. So at the end, this is the total cash to close that client would have to bring to the table for a $150,000 MLS property. It would be $25,000. Okay, so that's who you want to make sure that they have, if not more, ready before you even start shopping for properties around that $150,000 market price.
So within that cash to close, they're going to have their down payment, their prepaids. You somehow
Yep.
got paid.
Yep.
So tell me where the investor makes money in this model. Show me the number that make the investor his money.
So now we get to the exciting part. So they found that property, they like it. So, and here's where you come in. So, essentially, our business model is going to be two closings. It's going to be a double closing on the same day. So, you're going to buy the property. You can buy it cash, but if you really want to scale this easier, you can use a loan. You're going to put down 20%. So, you're putting down 30. Your interest rate is 5%. And these are just generic numbers. If you have your own lender and you're able to get lower numbers, more power to you. Your spread is going to increase and therefore your cash flow is going to increase. And so this is going to be your minimum monthly payment. And at the end of it, all total closing costs, agent costs, earnest and money. We have everything that you'll see at the HUD right here. Your total is probably going to be around $35,000 to close. Now, now this is where we get to the fun part. This is the closing costs for transaction two. You're also going to have closing costs for transaction two, which is taken from your profit from transaction two. So this is the amount of cash that you'd get from
Before we get any
transaction.
further, can you explain transaction one and transaction two? So what is transaction one?
So transaction one is you buying the property with
On
your
MLS.
lender. Yes.
On MLS. So you go on
Yep.
MLS, you offer some kind of a price on MLS, your offer gets accepted, that's your
Yep.
transaction one.
Yep.
And that specific house you're buying because your final client, whoever is going to be, who is going to be the client of your rep, that's the property that client selected.
Yep.
The client select the property, you make an offer, you set up the option fee and earnest money just like on a regular house, right?
Yep.
And then what's transaction two then?
Transaction two is the transaction between you as the lender and the client. So the client would then buy the property from you since you've just bought it.
So how would that work? Whom do they make an offer to? How do they make an offer?
The
And
client is making the offer to you at the same time.
okay, so you go and you select they tell you the property that they want to select.
Yep.
They're interested in. You
Yep.
go ahead and make an offer on that property. Let's just say that you presented an offer and the agent tells you offer been accepted. At which point do they make an offer to you?
At which point, before you send your offer, they're going to make the offer to you.
Okay, so before you even send your offer in for
Yes.
that property that they like, they're already presenting you an offer at what price? So let's imagine that transaction one price is 150, as you mentioned, right?
Right. At this price.
Okay, so your offer
165.
on transaction one is at transaction price is 150.
Yep.
They're making you an offer for,
165.
oh, okay, so we now have two offers, right?
Yep.
Your offer is at 150, their offer to you is 165.
Yep.
Go, okay?
And so with that, you're doing two transactions in one day. So the ownership is going to transfer to you as the investor and then to the client at the end of the day. And so this is where you have your closing costs from transaction one, and this is where you have your closing costs for transaction two. And your profit is subtracted from the closing cost, and this is that number. So this is the money that you are receiving in your pocket from the end of transaction two. And this is the money that you've spent on transaction one. And this is our consultation fee because this is our service that we're providing you. This is your markup. So this is the forced equity. Since you put that 10% markup, you've basically forced equity on that property of $15,000. Now, anytime that client is looking to refinance or looking to pay off the loan, you're going to get paid this immediately. And then this is the net cash. So this is all the cash that you spent minus the cash that, or all the money that you've gained minus the cash that you spent. So you've spent about $20,000 here. So now getting to the cash flow. So now, the difference between what the client is paying and what you're paying. So there's going to be two liens here, right? Lien between you and your lender and you and the client. That difference is going to be this number right here. This is your spread. And like I said before, with the rentals, with your cash flow, you're not certain that you're going to get that cash flow every month. Here, you're going to get this payment every single month for the next 30 years. You're going to get this payment. And that payment with the amount of money that you put in. So you've spent $20,000. You spent $20,000 and you are now receiving $500 for the next 30 years. That is a 35% cash on cash return, right? These are bonker numbers when if you're comparing it to a rental. Now, you can see throughout the years how much cash flow, just cash. This isn't because remember, right? You're paying down your debt, you're building equity in this property. The client's building equity in this property. So there's also that. This is how much money you would have made by year 3. By year 3, you would have made $20,000 in cash alone. Okay, just in cash, you would have made all your money back, right? And it just goes higher and higher and higher. And these numbers, if you were to compare this to a rental, it would be night and day. Like to get these numbers for a rental, you might have to own like maybe 2 rentals. So for one of these, right, you'd probably have to buy like 2 rentals, and maybe not even during times like now where you have to really overpay for everything. And so that's what really makes me really excited about wraps, is that it's just such a, and this entire process is not, you're not, this is fairly easy process. Okay, you're not talking to wholesalers, you're not having to convince everyone on our team, and I mean the mortgage insurance, the title, our realtors, everyone on the team knows this process and knows how to get it to closing. And so that's really what you're paying this consultation fee for. This is the service that we're providing, and it's very easy. It's very easy. It's not hard at all.
When you mentioned your team, so what would your team do? Let's just say that somebody walks up to you and say, okay, Sam, I am interested in passive income. How can you help me?
Right. In that case, I would need, what kind of client are you looking to have? What is your qualifications for the client? And we have our beautiful realtor Elena, who is constantly getting clients for us. And so we'll be able to match up clients that fit your qualification standards. And we have our own way of qualifying the clients. I myself am well, soon to be a loan officer, so I know how to qualify people. And you'll be able to choose and select which clients you'd be okay lending money to, and then you just go from there. The client would then, once you pre-qualify and say, okay, you know what, I like this client, they have enough to put down, I like their job, they're making enough money, I like their payment history, let's get started on this. And so Elena would then start shopping houses on MLS. So you're not doing a thing, right? Elena would start shopping for houses on MLS. I, as the agent, would then send in an offer, and the client would then send an offer to you. Hopefully that gets accepted. You sign the other one, and then the transaction begins. You see how little work here there really is.
Well, I think the real work actually will, unless you have people who know what they're doing in the title company, you're not quite done yet. So tell me how what's your experience with title company and how you can help them, because title companies are not all very understanding of the process.
That's very true. There's not a lot of title companies in the entire Texas that is very knowledgeable about wraps, but thankfully we have one of the best title companies we closely work with and constantly talk to, and Alan T. Shesker. The Shesker Group, those guys do wraps all day long, and they know us very well, and they know how we like our contracts to be written. Um, and they do wraps not just for us, but they do it for other investors who do wraps all day long. And so our when I say our entire team is knowledgeable about what's happening, they know what to do.
Now, one of the stumbling point that a lot of people have is how do you acquire the possession of the property on transaction one, because there is such little thing called due upon sale, right? So tell me a little bit more about that.
I'm sorry, what?
Due upon sale, due on
Yeah.
sale.
Hmm.
So a lot of people try to do wraps.
Yeah.
Let's just say that they go to their mortgage lender, whoever their mortgage lender is, and they say, "Hey, I want to take in a not my own property, but I'm going to do an investment property loan." Okay, so we have an investment property loan for 15% down or whatever it is down. But
Mhm.
then when they try to do a wrap, then the title changes hands, and what everybody's scared of is the
Mhm.
due on sale clause, right? Can you tell me a little more
So
about that?
that happens when the lender sees that um that someone else is on the title and they don't see you anymore. But we completely bypass that method, and the reason why is because we write the mortgage insurance company that we use writes it in a specific way that we still show on there so that the lender's okay with it, and we don't get that to
So,
happen to
so
us.
you solve it through your title,
Yes, we
right?
solve it through
So
title.
the due on sale clause is bypassed by using the title lawyer writing up their paperwork.
No, it isn't the lawyer in particular. It's the lender wants to see your name on the mortgage insurance,
Okay.
right? And if it's just the client's name, they're going to raise the question and they're going to not, they're not going to do it. However, because of the way our team is structured, we do it in such a way that your name is also on there. So the lender is not going to do a due on sale.
So as far as the lender is concerned, your name is still on the title insurance and just another name been added
Yes.
to it, right?
Yes.
This is how you bypass it. Now tell
Yes.
me a little bit more about the regular insurance on the house, because the way very often that the lender knows that something changed, although in this case it might be moot at that point, is that you have to add another. Let's just say that my client,
Mm,
I'm a realtor, John Blow, he wants to go ahead and do sort of financed property from you, right?
mm.
You acquire the property. How does the insurance will work in that case? Who is the insured parties?
Who insured the investor, which would be us, and the client.
So you both are insured on the
Yeah.
insurance policy
Yes.
together with the lender.
Yes.
And your insurance company that you work with knows how to do that.
Exactly.
So tell me again, how many people are on your team? Because I'm trying to get to that. So you have me, obviously. Thank you. I appreciate your referrals. Then you have title company that you work with closely, right? That's two. You have an insurance company that knows what to do
Yes.
for the insurance. Then
And then a loan service company.
you have a loan service company that knows
Yep.
how to handle this. So once
Yep.
the whole deal is said and done, they actually can service the loan.
Yep.
Do you have any lenders who would actually lend for this deal?
So, generally, like I just said, the lender just wants to see your name on there.
Okay, it
If
doesn't
you
matter.
work
They
with
can go to
us,
any lender.
yes, it should work. If you work with us, generally it doesn't really matter. What we used was Citibank. I know other investors use other lenders.
And when you
Um,
say Citibank, are you talking about CITY or CITI? There are two Citibanks.
CITI. Oh,
CITI.
really?
Okay.
There's two Citibanks. I actually did not know that.
Okay.
CITI, yes, ma'am. Yes,
Yes.
ma'am. Um,
So you're using Citibank. Okay. That's what you used
I
in
myself am gonna start soon being a lender myself.
okay.
So, I'm I'm right here.
Will you be able to do investment loans?
Investment loans. I think so. I definitely have to talk with
Because
someone. That was
because I know
actually,
that there's a
yeah.
difference for residential and investment loans, I think.
Yes, there is, and that's why I put, you know, at the end of the day, if you can get your numbers even better than what we have written on here, like on here, I wrote down 20%, 5% interest, right? That's what just we could get. If you can get that even lower, all power to you. That just increases your cash flow.
Gotcha. So before we wrap up, kind of summarize again, what is the benefit? Because we already talked for about 30 minutes or so.
Yeah.
What is the benefit of them using that model than just, because it's a lot of numbers to process, rather than just say, let me just get another rental and put a guy into it, right? So remind us, why
Yeah.
do we want to go through these two transactions?
So the reason why you want to go through these two transactions, one, because it's just less work. I cannot stress
So
how
in
much.
any of these transactions, do we need to do anything about repairs? Because we have transaction one, transaction two, we buy the
Yep.
house as is, we give the client the key to the house
Yep.
as it is, right, on the day of the closing.
Yep.
After that, do we touch the property at all?
Nope.
We don't touch the property ever,
Nope.
unless they
Property's not your
misbehave, right?
concern anymore.
Unless they misbehave. Gotcha.
Yes.
Um, Now tell me, what are other fees or costs of working this model? Like, let's just say that we can see the closing costs. Can you pull up transaction one, transaction two closing costs again?
So this is transaction one for the investor. This is transaction one closing costs, and this is your closing costs for
So for
transaction two.
them, they need to have 34K in this specific scenario, $150,000 property. They need to have
Yes.
34K cash to close on that property.
Yes.
Okay, but there in the end, that 34K is going to, it's transaction one, because there's still transaction two coming in, right? So
Yep.
they're not out of 34K on day
Yep.
one, right?
You're gonna be reimbursed 18 grand.
Right. So you're only out of $18,000 on at the end, like when the first closing starts, you
Yep.
have to present your cash to close, right? You
Yep.
have to do the you have to wire your 34K.
Yep.
Then your client on transaction two wires their money, right? So
Yep.
your net from that day is minus $18,000. Now, a lot of people, let me ask you this question. A lot of people
Yep.
say, well, why would I want to do a net $18,000 in a red for myself? What would be the purpose of that?
Well, a lot of the time with rentals, a lot of the time you're not going to be able to have what we call infinite cash flows, where you make money up front and you're just making money from there. Those are really rare cases, and you're not going to be able to do that a lot in a year. With this is, sometimes us as investors, we just need to pony up and actually invest money, and this is what it is. This is an investment. A lot of the time you're going to be out of money even in your first rental. You're going to be losing money, and so this really isn't. if,
And
if,
when you
if
say
you can.
losing money,
Yeah.
what do you mean by losing money? Because most of them at least want to try break even, or so they think, on
Yeah,
their rent, but then they forget that they just pay down payment and closing costs, right, on year one.
exactly.
A lot of people overlook down payment and closing costs when they calculate their cash flow on year one.
Exactly. So even in rental terms, you're year one, unless you're buying, the perfect scenario, which is the property needs repairs, right? You do the repairs, which, by the way, you're going to be in the hole that entire time, and then you refinance, and then hopefully get all, hopefully you get the amount that
Hopefully,
you're
right?
looking for.
With
Yeah.
hopefully being a key word in there.
Right, and even in that whole scenario, you can see just from that how much work that really is. And
And
with
scalability of that. What is the
exactly.
scalability of that? Because if you're buying the property like that, your flip is going to take what, a couple of months?
Yeah, your flip's going to take a couple of months. The closing itself is going to take one month. um you know finding the client to actually rent the place is going to take maybe a week, maybe a week or two.
You still need to pay rent, pay your realtor, right, to market
You
your
still
property.
need to pay a realtor. Right, you're still in charge of basically all the repairs. So a lot of people, when they see this net cash that they're losing money up front, you don't understand when You're most of the time you're going to be losing money up front.
Regardless, right?
Yeah,
There is no perfect solution. Yes, in fact, a lot of people when they come to me, they said, "I want a positive I want to find a rental with a positive cash flow." I'm like, it will be positive cash flow after a little bit. On year one, you're still going to have to,
yeah.
be quite a bit out of pocket.
Now there are again, right? There are deals where you can make money on the upfront and can make money from then on, but they're not common deals, right? Those
Mm-hmm,
are deals you really have to dig through, and you may do one or two of those a year, right?
mm-hmm,
With this, you can do this as many times. I mean, this is not simple at all. And you can imagine, if you have, like, for example, right, I'm about to talk to someone here, who has he has like $200,000 right now available in cash, and you can see the amount of times, if he were to just repeat this process a few times, how much cash flow he would stack. A lot of people have goals of having like 5,000 cash flow a month. You can see how easy it is to attain that through this method.
mm-hmm. Sounds good. Now, speaking of time, it's 2:54. So I don't want to hold you longer because I know that you had other things to do. If you don't mind, let me switch to my presentation so we can show them how to get in touch with you.
Okay.
So my screen share. In that case, now that we've seen the calculations and we've seen a little bit of behind the scene, how the numbers look like, let's talk about how to get in touch with you. So what's the best way to contact you?
Best way to contact me really is my email or by phone number.
And I'm going to put
Um,
it up in or down, down in our description.
yeah, those are the best ways to contact me. I'm not very active on social media, honestly. I'm too busy
Okay.
for it. So,
Okay.
yeah.
Okay, so for those of you who want to understand the process more and talk to Sam one-on-one, use his email. I'm going to put it in our description and leave your comments. Let us know how we did. If we if we presented the information in a way that you feel that you're ready to pick up and run with this model, do we need to do a follow-up video to explain any other points that you don't feel were covered enough? Let us know and we will try to do another video. In the meantime, thank you so